IVM.
Welcome to another week on IVM. It's been a great week. If you aren't following us on social media, please make sure that you are. We're IVM Podcast on Twitter, Facebook, and Instagram. On Cyrus Says this week, Cyrus is joined by actor and comedian Gaurav Gera. They talk about Gaurav's journey in showbiz and the inspiration behind his Shopkeeper Behenji sketches. On Simplified, Naren and Shrikant are joined by guests Avanti and Zain from the Marvel's Lost and Found podcast. On Geek Fruit, Tejas and Jishnu give their take on Ant-Man and the Wasp and discuss the future of the Ant-Man verse. I'm really looking forward to that. That was a great movie. On Varta Lab, last week, founder of IVM himself, Amit Doshi. Hey, that's me. Talked to Akash and Naveen about being Amit Shah's doppelganger, my journey so far, and how he started on IVM podcast. I'm sorry if that grammar was twisted. On Keeping It Queer this week, we have the producers of Vaisa's latest web series, Sex Rated. And with that, let me take you on to your shows.
Folks, welcome back to the Fixed Income Special at Paisa, your podcast about personal finance. I'm your host, Anupam Gupta. I'm B50 on Twitter. This is the third and final of our Fixed Income Special series. In the first part, we discussed an introduction to fixed income. What are the various instruments? What are the various concepts? In the second part, we spoke about fixed income instruments like fixed deposits and mutual funds, and how does the RBI policy impact the fixed income market. In this third and final episode, we're going to talk directly about fixed income in your portfolio. Okay, why should you have fixed income in your portfolio? What you could invest depending on your requirements. My guests, my experts in this three-part series are R Sivakumar, the head of fixed income at Axis Mutual Fund, and Lakshmi Iyer, who is the CIO debt and head products at Kotak Mutual Fund. Guys, welcome back. Thank you so much for doing this episode. Tell me, Lakshmi, why should a retail investor, consider fixed income as part of his portfolio?
So I'll digress a bit. I will take an analogy of I'll invoke the foodie in me again.
Okay.
I think asset allocation, or when you make investments across asset classes, is like a thali system. You require the right amount of carbs, proteins, calcium, vitamins, and yes, even fats in your portfolio.
Of course.
So if I blend all of these together, you get an asset allocation which has to, encompass financial assets, which is largely equities and fixed income. And then you have physical asset classes, which is predominantly real estate and gold. Again, in these four asset classes, gold is a natural pull, especially for investors in India, consumers in India, and especially women.
Okay.
And real estate, we think it's Teflon coated; it never falls.
Correct.
And it keeps rising forever. Again, this is a fallacy, but for whatever reason, that has an inherent fan following. Then when we move to financial asset classes, it's equities and fixed income. Again, there is a natural pull effect into equities because it's largely popularized. It's very well covered across media. And then we have the lesser model, which is fixed income, which people swear by, because if you look at the banking industry today, it's 100 lakh crores. And if you look at the mutual fund industry within fixed income, it's about 17 lakh crores.
Okay.
So what I'm trying to say is that this asset allocation will mandatorily mean that every retail investor has to have some small dose of fixed income just so that you have a stability on your portfolio.
Okay.
So as I said, if you are seeking growth, if you want to make $100, $200 in like 5, 7, 10 years, whatever the time horizon is, then equities is mandatory. There is no option.
Okay.
That kind of money is very difficult and seldom made in fixed income. But if you want, you made that $200 and then you want to preserve that, you want to have a slightly more stable bias on your portfolio, कि वो 54-58 से ज़्यादा कमा के दे आपको, that kind of money should definitely go into fixed income.
Okay.
You can, of course, there is no rule of the thumb which determines that how much should Anupam have in his portfolio fixed income vis-a-vis Lakshmi or Shiva. I think that is predominantly a function of each of one's risk appetite. And more importantly, what is our need cycle, which either if you believe you are good enough, you do it yourself, or please engage the services of an advisor, because everything in life is not free.
Yeah, because obviously someone who's just starting his career, his requirements will be different from someone who's in the middle of his career, someone who's retiring. But at all three phases, you should speak to a financial planner about having an element of fixed income in your portfolio.
Absolutely. There, I would suggest that you should not use your Google Buddhi. I call it the Google Buddhi because everything is available on Google, but not this kind of a customized solution.
Yeah, because there are so many products out there. Siva, how does fixed income affect the other asset classes? I know there's a linkage out here, okay? And I'm pretty sure that even if I'm buying equity, like what Lakshmi said, if I've got very high growth expectations, there is a certain interplay between all these assets. She spoke about real estate. She spoke about gold. I have no idea about gold. Honestly, I have no clue about that. But I know that interest rates and fixed income and equity, there is a broader overplay out there. Why is it useful for a retail investor to also keep track of fixed income? Because there are implications of what happens in the fixed income which might happen in other asset classes. Can you tell us about that?
Okay, I will answer this, but also in the context of your previous question.
Please.
Okay,
please.
So if you look at the last 10 years, what do you think has done better? Do you think equities have outperformed or bonds have outperformed over the last 10 years?
Tough call. If I look at, this 2008-2018 is a horrible time frame, okay? Because equities were...
Reality is that because we are comparing, of course, equities have had a fantastic last couple of years, but you're comparing it to the 2007-2008 bull market. Exactly. So obviously it's a bull market now, but it was also a bull market on the base. Yeah. And actually, if you look at the 10-year return starting in, let's say, 2007-2008 to now, bonds have outperformed. Just a GSEC portfolio has outperformed the Nifty.
Oh, okay. That is so counterintuitive.
So that's totally... This is long term. We are not talking about 1 year, 2 year. We are talking about 10 year. All right. When did the NSE...
Hold on. I'm going to put that in perspective for our listeners, okay? What Siva is saying is that over a 10-year period, the Sensex, my guess, is probably remained flat-ish.
No, it's still positive. I think coupons, dividends reinvested probably about 6 or 7% per annum.
Versus
a little over 8% per annum. It's not very big difference, but it is still an outperformance for, and this is only GSEC. So we're not talking about corporate bonds which are higher yielding and all that. We just talk. And of course, on the equity side, you can say, I could have bought mid-caps or small caps.
Just benchmark to
benchmark, right? Benchmark to benchmark, G6 over the last 10 years better than Nifty. All right. So when did Nifty get launched? NSE got launched 93, 94. Right? Yeah. That's also the time RBI liberalized interest rates and the bond market in India started. Yeah. So if you go back to 1994 to today, the same applies. GSEC benchmark has outperformed the Nifty since the Nifty launched.
My God, there's some myths are being busted out here.
Absolutely.
20-year returns,
so
GSEC has given more
nearly 25 years. GSEC again has outperformed equities in India. Now this all is like so totally mind-blowing.
It is counterintuitive.
It's completely counterintuitive. It is simply slow and steady wins the race. Okay. If you don't have those big plunges like you had the tech bubble busting or the global financial crisis, you have those few years which really knocks out a large part of your equity return. Correct. And I think that just avoiding that is really why. So in a core part of your portfolio, you need to have a reasonable allocation to fixed income. And I think people forget this because it's not a hot asset class. It doesn't have stories. It doesn't have coverage, as Lakshmi said.
Auditor resigned and therefore stock price fell down or something.
No sensation.
No sensation. Much less sensation. So I think it's really I think as an asset class. And by the way, this is not just Indian data. You see everywhere else in the world. And these differences are not large. We are talking about over 10 years, 20 years, 25 years. The gap in performance is maybe 1% off from each other. So it's really not a big gap to say that all my wealth should go to equity. I think that's what it comes down to. You need to have a reasonable allocation to ensure you're not missing out or you're not overexposed to one asset class. That's the first thing. And the second thing with the question that you asked, are these two linked? They are absolutely linked. Because when rates go up, what happens is, let's say if we were at a 10-year yield in India of 6.5% last year, and now we are at 8%. What that means is I can just buy a 10-year bond and I can now make 8% versus what I could have made with 6.5% last year, correct? So it's a lot more, there's a lot more reason to own bonds today. Fair enough. Now in equities, we don't usually use a metric like that. No, it's not a yield. We use PE, price earnings ratio, which is the opposite of a yield. That is, EP is the yield of a equities.
Correct. The reverse of
PE. It's the reverse of PE, right? Now, the question is, shouldn't there be a link between earnings yield and bond yield? There should be.
Of course.
And many people in the West especially believe that there is a linkage between bond yields and earnings yield. That is, when bond yields go up, earnings yield also must go up. And now since earnings cannot go up, price has to come down.
Correct.
So which is why people look at interest rates and say if interest rates rise too rapidly, it could lead to a correction in equity markets. So there is a link, and there's a very core link between what's happening in bond markets and what's happening in equity markets. You do have leads and lags. So the bond, for example, if you go back to 2007, 2008, when the US had this big recession, the bond markets flagged off this much earlier than the stock markets. The stock markets took maybe a year or two to figure it out. And the bond markets are already giving these signals. So but if you look at bond markets, you can very often tell what's going to happen in equities maybe a year or two down the road.
And that makes sense, right? Because we are at 8% on the 10-year yield. I think we are up from 6.7?
6.5.
Yeah, 6.5.
So that's 150 bips increase in the 10-year bond. And guess what? The Nifty has done nothing this year.
Well, it's gone up during the same period of time. Yeah. So that's the beauty of it. I mean, I think when you look at any stock model, you know what's called a discount rate, right? So you look at the future cash flow or earnings model, and then you discount it. What is the discount rate? It is nothing but a yield. And that yield in turn is linked to the bond yield. So I think when bond yields go up, unless you believe that earnings have the trajectory of future earnings has also gone up, right? There are certain risks, and I think it's very important to track the market. It doesn't automatically imply a sell, because bond yields can go up because growth has gone up.
Correct.
If expectations of growth goes up, then yields can. But expectation of growth goes up is good for equities.
Yeah, I know. So, the last part of this show, I want you guys to give me 2 products each, okay, which a retail investor can look at, okay? You guys just share it between the two. You could probably do ultra short term and say something medium. You could probably go for credit opportunities and whatever, GSEC. So, something like that. How about that?
Oh, sure. Good.
Yeah. Lakshmi, you want to start?
Yeah. So I think, we are at a stage in terms of interest rate cycle where there are too many variables, which is, to be very honest, confusing even bond managers and veteran bond managers. So obviously I can understand that the investor will be even more confused. Not that he needs to track everything with details, but then are there strategies? And we discussed in one part of your segment that if fixed income offers I would say all season solution, and that all seasons is all seasons macro views which are emanating from decision making. So I think in this kind of a market scenario where we think that interest rates are not going to come down big time, it's not going to keep moving northward in a big hurry. We are somewhere at a stable to marginally rising interest rate scenario. I think a better suited strategy in this kind of a market scenario for retail investors who live and drink, eat, breathe bank FDs, the closest would be, say, credit-oriented funds. They call credit risk funds. Now, these typically invest predominantly in corporate bonds across rating spectrum.
Which means that it could give to the safest company to the riskiest of companies.
So the threshold is BBB minus, which is investment grade in India. So at least there. Usually if you scan through these portfolios, and these funds have been in existence in India for over a decade now. Barring outliers, most of these portfolios have been centric around AA, which is not very high on risk profiling. So I think these would be suited to an investor, but with a minimum 3-year investment horizon.
They're called credit opportunity funds?
They're called credit risk funds now in the new avatar.
Credit risk funds, folks, if you've got an outlook of 3 years.
That's right.
Anything else?
And if you are very clear that I don't even want this kind of a small adventure, so this I would call it like a merry-go-round. So it could make you a little bit dizzy. If you just don't want that at all, then you should consider fixed maturity plans, which basically the portfolio manager actually buys and locks in assets till maturity. So if you decide, I want to do a 3-year fixed maturity plan, that's the closest I can give you. Like if you love chicken and there's Shivratri going on, or there is some season, I give you mock meat. That's soya chop. That's right. So that's the closest we can give you as a mutual fund industry. But again, there is no rate assurance. See, let's be very clear from an audience perspective that there is no rate guarantee in any fixed income strategy across the country. And if someone does that, beware.
Mis-selling, obviously.
Absolutely. That's key. And of course, if you are none of these are appealing to you, and you're very, very clear that I'm not even egalitarian, you just want to be in government securities, then of course then you have the plain Jane government securities fund, which are the purest and the most, I would say, sovereign risk, or therefore hardly any risk. But then you have to be for the longest time, and then not really worry about because that's going to be like a roller coaster, given the way interest rate curve is right now.
Folks, 3 things out there, the credit risk funds, FMPs, fixed maturity plans, and the GSEC funds, Speak to your financial advisor about your risk return profile. Remember, we are doing no recommendations on the show. Go figure it out, speak to your financial advisor. But this is just to familiarize you with the kind of products that are there. Credit risk fund, fixed maturity plan, and a G-Sec fund. Okay, Siva, shorter side.
Yep. So I think if you don't have that 3-year horizon, what do you do? And I think there is a whole bunch of products in the industry, starting from what's called a liquid fund, which is suitable even for one-day investment. Is this just the money which you are just leaving idle in your account?
Correct.
Can I make a little bit better yield out of that? They have a bunch of money market products which in our parlance are called things like low duration and ultra short funds, which also have very high quality, highly liquid portfolios, but are geared to give you something a little bit better than what a liquid fund can do, but with a very low risk. If you step up and you say, I've got 3 months, 6 months, 12 months money, then there are products in the short term, what's called short term funds, etc. So the industry does slice and dice, and you therefore, depending on whether your horizon is in less than 3 months, I can give you a liquid fund. If I have, let's say, a 1 year, I can give you a short term fund. So it's really about matching your investment horizon to the kind of investments that the fund makes. So if your expected duration of investment is 1 year, we can find a fund which is also about 1 year. That kind of reduces the risk of your investment by matching closely. It's nothing eliminates risk in this world.
Obviously,
but one way to manage your risk when it comes to buying a fixed income fund is to try and match, not perfectly, but try and get the duration of the fund close enough to the duration of your own investment.
Folks, let me just put that in a few examples for you, okay? Is appraisal season on right now, or it's over? It's over. Okay. So you've had a fantastic year. You've had a great bonus, and you've got lots of money in the bank account. You're not very sure what to do about it. Okay. You've still to figure out what assets, where you want to invest this. Maybe it'll take you a week to figure it out. Maybe it'll take you a month to figure it out. So when you're looking at a place to park that pot of gold that you've just got, you could just make it into an FD into your bank account. That's the safest. What Siva is saying is you could consider anything from liquid fund to ultra short term funds. Have I got that right?
Absolutely.
Okay. And once you figure that out, then, you just have to, you could use any of the platforms to park your money in that, and you would get a little bit, say it would give you FD plus XYZ%. I don't want to get into exact numbers right now, but safe to assume that between 50 bips to 100 bips, more you could get with that. Siva, so these are also in high quality stuff, right? I mean, I'm not taking the credit income risk out, the credit risk out here, right?
So one of the elements that drives credit risk also is how long you hold that bond.
Correct.
When you look at rating agencies and they look at the bond's maturity also when they give a rating. So if it's a 2 or 3 year or a 5 year bond, then they have a rating scale like this AAA, AA, etc., which kind of tells you what is the medium term risk of that particular instrument.
Correct.
But if you're holding a 2 month paper or a 3 month paper, you more or less sure this company is going to be around to pay it back at the end of it. So the risk of these instruments is a lot less than, so when you look at the shorter tenor instruments, even if they carry some amount of corporate bonds, their risk tends to be a lot less than credit risk products.
Okay. Let's take one more example. You think the markets are too overvalued right now and you want to sell a bit of your equity portfolio, but you have no idea when to go back to. Maybe you could wait for a year. So ultra short term, I think, would be up to a year. Siva, what do you say?
So in the new definitions, ultra shorts is below 6 months. So there's a new carve out called low duration, which comes in the below 1 year space.
Okay.
So these are all funds which are suitable to just, I've got some money.
Temporary parking your money.
Parking, next 3 months, I'm waiting for an equity market correction.
Sure.
You could be using it to do an SIP. It's called an STP, a systematic transfer plan.
Yeah.
So, while you're doing a systematic transfer plan, you earn some interest or some kind of an income on that. So these are kind of strategies which you can use. And when it comes to your own fixed income investments also, you can use systematic tools to optimize your way out. I mean, fixed income, typically we don't talk about SIPs, but you can use SWPs, systematic withdrawal plans, to kind of get you a certain income in the form of a regular cash flow, and it's very, very tax efficient compared to.
For the retirees, it's good. I mean,
absolutely,
you can just probably just put a pot of money into one of these funds out here, and then every year systematically withdraw
every month, every quarter, every year,
depending
whenever you want, whatever your cash flow needs are, you can just make a systematic withdrawal, and it's a lot more tax efficient than waiting for a dividend stream or some other kind of a distribution.
And with a little bit more certainty, I'm sure.
Oh yes, because the dividends in a mutual fund are always dependent on actual profit booking or income booking by the fund. So whereas in a systematic withdrawal plan, that call is entirely up to you as the investor, and it doesn't matter what the fund manager is doing.
Yeah, folks, so you want to check with your financial planner and your chartered accountant, okay? Because these debt mutual funds have got a lot of funky tax angles to them. I really don't want to get into that because that would require an entire episode on their own. There's like dividend reinvestment and there's all kinds of stuff. Please consult your chartered accountant about the tax impact of all these funds, okay? I'm not getting into that. Last and final, guys, tell me about your respective funds. Okay, I mean, how old are they? What kind of products do they have? Again, on the debt mutual fund side, Siva, what about you?
Yeah, I think we at Axis Mutual Fund, we started in 2009. We are relatively young in the scheme of things, although most of us as managers have been around as almost as long as the mutual fund industry has been around. And then we are full service, so we do offer the full range or most of the range of fixed income products. And one of the categories which we didn't spend time on, which are called the hybrid or categories, which manage both equity and fixed income into the same portfolio. So you have an asset allocation built into the fund itself. So we offer a whole range of these funds. Okay. I think it's been a great start for us as a fund house. We are a little less than 10 years old, but I think it's been a great start. And
you are I of Siva on Twitter.
That's right.
Folks, if you have any questions, please feel free to reach out to Siva on Twitter. IYEOF.
That's right.
SIVA. Okay.
EYE of I of Siva. I think it's just
third eye there or something?
Yeah. I mean, it's whatever. It's supposed to. I suppose.
You get angry. That. People should be scared or something.
Why not? It was available as a handle.
Yeah, so
but there's only one I in the SIVA.
That's true.
Please reach out to Siva on I of Siva on Twitter. You can check out the entire range of Axis Mutual Funds, debt mutual fund products, as well as equity mutual fund products on the website, which I believe should be accessmf.com, accessmutualfund.com.
Accessmf.com is right.
Yeah.
Yes.
You can go and check out. They've got the entire range of funds. Lakshmi, all yours.
So we were incepted in 1998 as Kotak Mutual Fund. We launched the country's first gilt fund. That's the only thing, because in 2 decades, the gilt fund size at one point in time was lower than the gold ETF size. Just to tell you what kind of fetish people have for gold in India.
Oh, wow. Okay, that's statistic.
Then, so at this point in time, we are managing assets under management onshore about 1,35,000 crores, of which almost 80% is in fixed income. We also manage offshore assets, which is close to about $2.5 billion, of which about $1.5 billion is in fixed income. And I mean, we pride ourselves calling, we want to be the one-stop shop for all financial needs. So if you want gold, you want gilt, you want gilt-free investments, you want fixed income, you want equities, you want all of that. We say it's more of a one-stop shop, a departmental store over a Kirana store, I think. So that's where we are.
Fantastic. Your Twitter handle is?
At Lakshmi 1876.
1876. Some historical significance?
No. It's just my date of birth.
18th. Okay.
18 December. I didn't have place for December, so I said.
Right. Okay. The website is kotakmf.com.
That's right.
Please check out the website for every possible information on all their products. Believe me, Axis Mutual Fund and Kotak Mutual Fund are among the biggest mutual funds in India. They've got pretty much all the parts of equity covered and all the parts of debt covered. You should check out the website and reach out to them on Twitter in case you have a query. Siva, thank you so much for being part of this show. Lakshmi, thank you so much for being part of this show. Folks, thank you for listening.
No material on this show should be considered as financial advice. The material on this show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Hello there, my name is Naveen Narona, and as a gay person in India, I get asked a lot of stupid questions.
Beta, is it LGBT or eligibility?
How do 2 men procreate?
Bro, is Grindr better than Tinder or what?
We answer all these questions and much more on my podcast, Keeping It Queer, where I talk to individuals from the LGBT community in India and learn about their personal stories. Catch all the episodes on the IVM podcast app or any other podcasting app you like. Till then, keep it queer.
Why don't we talk about mental illness? For that matter, we don't even talk about emotional wellness. And if we can't talk about either of these basic, very basic aspects of being human, what do we do when we just feel like something's not right?
Hi, I'm Zain.
And I'm Avanti.
And this is Marbles Lost and Found, a show where we invite conversations about mental health and illness and just get people to talk about it, because it's okay to do so. Catch Marbles Lost and Found every Tuesday on the IVM app, website, or anywhere you get your podcasts from.